Let's say you drop dead 3 years after signing your whole life policy. Was that the smartest financial move you ever made, or the most expensive one? The answer depends entirely on your age, your math, and whether your insurance agent was more loyal to you or to their commission. Here's the uncomfortable truth sitting quietly inside most whole life illustrations. You are paying a premium that can run 3 to 10 times higher than a comparable term policy, and the pitch is that the extra cash builds wealth inside the policy. But when death shows up early, and sometimes it does, that gap in cost looks less like a feature and more like a very elegant trap. Let's walk through the numbers so this stops feeling abstract and starts feeling personal. A healthy 55-year-old male might pay around $450 per month for a whole life policy with a $500,000 death benefit, compared to roughly $75 per month for a 20-year term policy with the exact same payout. That is a difference of $375 every single month sitting on the table, which is either being eaten by the whole life machine, or in the term plus invest strategy, being redirected into an index fund, earning historically around 7 to 10% annually. If that person dies in year 3, the whole life policy has cost roughly $16,000 in excess premiums over what term would have cost. And the investment account barely has time to breathe. Now fast forward that same scenario to age 65, and the picture shifts a little, but not in the direction whole life salespeople want you to stare at. A 65-year-old buying whole life for that same $500,000 benefit might pay upward of $1,200 per month, while a 10-year term, if they can still qualify, might run $250 to $350 per month, depending on health. The spread is now pushing $900 per month. And if you invest that difference at 7%, you are building a parallel asset that whole life's cash value will struggle to outpace for well over a decade, sometimes 2. The irony is that the older you are, the more aggressively whole life is sold to you as the responsible choice, even as the math becomes increasingly uncomfortable for the policy. At age 75, term insurance becomes either unavailable, brutally expensive, or laughably short. And this is precisely where whole life defenders plant their flag and say, "See, we told you so." But here's what that argument quietly skips. If you have been investing the premium difference since 55, you have had 20 years of compounding working for you, and your self-insured nest egg may now dwarf the death benefit entirely. The historical pattern in permanent life insurance debates is almost comedically predictable. Every generation rediscovers the buy term and invest the difference argument, gets briefly furious at the industry, and then half of them still buy whole life anyway because the agent showed up with a nice brochure and their uncle swears by it. Dave Ramsey has been screaming this from a megaphone since the 90s, and yet whole life sales remain remarkably robust, which tells you something fascinating about human psychology and the power of a confident handshake. The misconception worth killing right now is that whole life is free money at death. It is not free. You paid for every dollar of that death benefit through premiums that exceeded the actuarial cost of pure insurance, often significantly. What whole life actually is, stripped of the poetry, is a forced savings vehicle wrapped in insurance clothing, useful for a narrow set of estate planning scenarios, and brutally expensive for everyone else. The practical lesson history keeps handing us is embarrassingly simple. If your primary goal is income replacement for dependents, buy term and invest the difference with mechanical discipline, not motivation. The discipline part is the hard part, because that $375 a month will whisper vacation or new truck if you don't automate it into an index fund the day the term policy clears. Position size and process matter more than any single product decision, and the person who buys a modest term policy and consistently invests the difference will almost always outlast financially the person who bought whole life and told themselves the premium was their investment strategy. The exception is the person who dies in year 1. And while that is a real scenario, it is not a financial strategy, it is a coin flip. There is something almost poetic about a product designed around your death that manages to cost you money both while you are alive and, in certain timelines, relative to what your family receives. We are not saying whole life is evil. We are saying it is a very specific tool being sold with very general enthusiasm. And that distinction is worth several $100s a month to you. At the end of your financial life, what matters is not which product you picked. It is whether you stayed consistent, kept your costs low, sized your risk appropriately, and did not let emotion drive your strategy into a ditch every time the market coughed. The person who quietly bought term, automated their index fund contributions, and never looked at a whole life illustration again will likely arrive at retirement with more options, more liquidity, and more peace of mind than the policy that promised them everything. Whether you die in year 3 or year 30, the math rewards preparation over persuasion, and the best financial outcome is the one you actually stuck with, not the one that sounded most impressive at the kitchen table with an agent. And if you are ready to take the next step in building real wealth through real estate investing, finding the right lenders, or getting contracting work done the right way, check out our links in the description below.